This week on the Business Owner's Corner, I'd like to explain some of the basic tax benefits of having an S-corporation. You may have heard that an S-corporation is a pass-through entity, or that it's kind of a hybrid entity that has characteristics of corporations and partnerships, and that it's a very convenient blend of the two. All those things are accurate. S-corporations are corporations themselves that have some of the legal benefits of incorporating on a state-to-state and national basis. But from a tax perspective, they're a little bit different. The most common type of corporation in big companies, I should say, are C corporations. And if you think of it this way, it makes it a lot easier. A C corporation has revenue from selling goods and services that comes in at the top of its income statement. And then it has a whole bunch of expenses, and then it has profit left over on its profit and loss, its income statement, and its tax return. In a C corporation, the corporation pays tax on those profits left over. And if any money comes out back to the owners through earnings, those distributions are taxed again. So a C corporation has this issue of double taxation that's a little bit problematic. An S corporation is different. An S corporation files its own tax return just like a C corporation does. It has revenues at the top, it has all its expenses, and then it has cash left over at the bottom, or profits at the bottom of its income statement. But unlike a C corporation, an S corporation doesn't pay tax on those profits. An S corporation files its tax return that lists all those revenues and expenses, and then it also files what's called a K-1 form, where those profits are distributed back to the owners pro rata. So if you're the only owner in an S corporation, there's one K-1 that goes out from the corporation to you, and any money that shows up at the bottom of the corporation's income statement and tax return is your responsibility when it comes tax time. So with the C Corp, you have this issue of double taxation. You have revenues less expenses equals profit. The corporation pays tax on that. And if you pull any money out through distributions, dividends, that's not through W-2, that's taxed again to you as an individual. In S corporation, you have revenues, expenses, and profits. The corporation doesn't pay tax on those profits. They're distributed back to you. You pay tax on your personal tax return. That's the exact reason why, if you have an S corporation, the filing deadline for that corporate tax return, which is an 1120S, is March 15th. It's so that the corporation files its tax returns and distributes those K-1s to owners and gives the owners a little bit of time to file their own individual tax return. So the government, the IRS, forces S corporations to file their returns a little bit earlier so that the owners have a few weeks to receive their K-1s and file their own tax returns by April 15th. This year, in 2023, for tax year 2022, it's actually April 18th because of a holiday and a weekend. But in general, that's the tax benefit of having an S corporation. Now, there are a couple issues here that we need to be aware of. Number one is, if you own an S corporation, you have to take out a reasonable W-2 wage commensurate to your efforts in the business. That W-2 wage comes out of the corporation in its expenses up here on the income statement and is assessed the payroll tax. Anything that sits at the bottom of the income statement as profits is not assessed the payroll tax. But as the owner of the corporation, the profits are going to be sent to you via K-1, and you will have to pay income tax on those profits regardless of whether the cash remains in the company account, whether you take it out and buy a car with it, or whether you take it out and put it in your personal bank account. It doesn't matter where the cash lies. What matters is what's left over on the tax return after expenses when the corporation files. Now, incorporating as either a C or an S corporation has other legal ramifications that you should be aware of in the state in which you do business and reside, I should say. That's something that you should talk about with your attorney. An easy workaround for this, if you want some of these tax benefits but don't want to incorporate, is to establish an LLC. An LLC has the option of filing taxes as an S corporation without becoming one itself. And an LLC, as far as a structure, is a really flexible kind of thing. You can create an operating agreement that works to your advantage, and you don't have some of the legal ramifications and responsibilities of actually organizing as a corporation in your respective state. So those are a few points that I wanted to clear up because this is a question a lot of people have. What are the tax benefits of having a corporation? It depends on whether you're a C corporation or an S corporation. Most smaller businesses who incorporate choose to be S corporations so that you don't have that double taxation issue. The drawback, one of these legal drawbacks I mentioned, is that you can't have more than 100 owners in an S corporation. So your larger corporations, particularly those that are publicly traded, are all C corporations for that reason. So they can issue shares of stock and exceed the 100 owner limit. That's it for today. Hope it was helpful.